back again.
It is the end of August, bro.
Another show. It has been, give or take, how we what date we decide to choose. This is pretty much like our year of doing this podcast.
That's right. That's right. Pretty close.
Somewhere in the middle, end of August. It's debatable. We did a few kind of like pre shows.
test runs. Yeah,
right? Yeah. Let's call it a year. I mean, this has been a year of doing
every week.
Every week, man.
Yeah, I don't think we missed 1 week. I mean, there's a couple weeks I had to do it from the road, but
yeah, we have. I don't think we have, and we're going to try not to miss.
Yeah, heck yeah.
What do you got for us this week?
All right, weekly update show 29 August 2021. So, with all the news happening this week, from the complete debacle in Afghanistan to all the worry about Fed tightening and Friday's Jackson Hole meeting, the market just keeps trudging higher, right? The S fund might have begun a breakout this week after being horizontal pretty much for almost all of 2021. We'll find that out over the next couple of weeks. This week is really just another example that the news does not drive the market. Trying to make TSP reallocation decisions based on expected market reaction to news is not a productive way to play the TSP game.
It's just not.
No. It's really not.
It's just not.
I don't know if you remember in the beginning of the week, there were a bunch of people asking about, on Facebook, what do you think about Afghanistan? This is before the bombing and everything, but
right.
What do you think that events going on in Afghanistan and other things will affect the market? And like always, I'm like, I have no idea.
How would we know?
Right. I mean, but would I presume that the market will go down because we have a completely knowable problem going on in Afghanistan? I would say it's already baked in. Right. That's what they do with all the other financial-driven data that comes in. If you know it already, then it gets announced to the public. The public is like the last to know. It's usually baked in. And that's why the market kind of goes in the other direction from where people think it's going to go, because they're just hearing about it now, and then they think it just happened now. But if you actually know what's going on, you knew it a long time ago.
Institutionally, people were already making decisions.
Yeah, right.
Yeah.
Watching the news and trying to make decisions day to day, not a great idea. Okay, so what happened this week? Super strong week for the stock funds. C fund was up about 1.5%. S fund definitely led the way, up almost 4.5%. I fund was up about 1.5%, and the F fund was down just a little bit, 0.05%. Okay, so this week we're going to talk about something that I've seen on Facebook the last few weeks. This idea of TSP goals. In this context, I just don't like the word, but we're gonna get to it. Then we'll take a look at the intraday chart like we've been doing for the last few weeks. There are some setups in there that I'm going to remind you guys from what we talked about last week and then how that turned out this week. Then I got a really interesting multi-cycle chart that I read the same chart. This company that put the chart together, I don't know how you can keep your intellectual property from going viral, but this chart's really good, and I saw it all over the place this week. So we're going to go over that. Spotify is the bonus chart, and then we'll do the 18-month weekly charts. Okay. So we've seen a lot of talk about hitting TSP goals on Facebook this week. There are things that we can control. So if you haven't read the ebook yet, you definitely want to do that. We go into all of this in the ebook. But in terms of TSP, the things that you can control is the amount that you contribute every payday, and you can control that, as you get promoted, as you move along in your career, as your circumstances change, you can contribute more or less. So you have control to some extent over how much you contribute, right? The amount of time you invest, you have some control over that, but obviously if you're 25, you have a lot more time that you can contribute, right? If you're 55, you're not contributing, and B, you only have so much time to maintain that investment, right? How you manage the money, whether you're a passive investor or an active manager of your TSP, though we've talked about that the last couple of weeks, those are things that you can control. What you can't control is what the market does, okay, which equates to your rate of return. So the daily TSP app, I think this is where some of this comes from. Daily TSP app has a really cool goal setting function. And it takes a lot of your personal data into account to tell you what you need to do to hit your target goal. At the end of the day, though, this functionality is a calculator, right? If you tell it how much you contribute and for how long, it'll tell you what rate of return you need to meet your goal, and or when will you hit that goal given an expected rate of return, right? So like we talk about in the ebook quite a bit, how much you contribute, you have control over. How long you contribute, you have control over to some extent. Your rate of return is the thing that, as you get further along in your career, your rate of return is the thing that's going to determine how much your pot grows, right? So in terms of a goal, right, if I say I have $500,000 in my TSP account now, and my goal is in 5 years to have $1 million in TSP, how can you go about meeting that goal?
What can you do to impact that goal?
What can I do to impact that goal? I can skip a meal once a week and contribute more to my TSP. Right?
Yeah, but although there's a max.
Yes, so there's the max. So there's a limit to the.
At the end of the day, you can max out your TSP.
Yeah, you can max out what you contribute, and you can max out what you contribute. Like there isn't much else that you can do on an ongoing basis to have any control really of what how your account moves up and down, unless you manage it, right? You're at the mercy of what the market does, especially if you're a buy and hold or an L fund investor.
Right.
If you follow technical analysis, if you actively manage your account, you still are at the mercy of what the market does. But theoretically, right, which is what we're doing here at Grow My TSP, we want to be in the stock funds when the market's moving up, and in the G fund when the to maintain those gains when the market's moving down. That's the best you can do. If the market's consistently moving down, it clearly doesn't care about your goal.
Right.
Right. So I read a bunch of these comments on Facebook all week, and I felt like I had to talk about it a little bit, because the idea of I met my goal. I mean, if you say I met my goal because I stopped going on vacation so that I could max out my TSP so that I could, then I'm with you. You've done something to forward yourself in this goal. If you sat there and the C fund kept going up, and you had no intention of ever getting out of the C fund because the market always goes up, and I know that, and I met my goal, sooner or later, you're not going to meet your goal.
That's a hope. That's a wish.
It's a wish. I have that written down. It's a wish.
It's not a goal.
Yeah.
Goals are things that you can affect, you can impact, right? Wishing and hoping are not the same.
Yeah. I actually wrote that down. If rate of return is what will enable you to hit your goal, and you cannot control rate of return, that's not a goal, it's a wish. Yeah.
There you go.
Yeah. So something to think about. I have goals too. My goal is to maximize my TSP.
That's what we
Whatever
do.
the market will give me is what I'll take.
We're going to try to take every bit of the market we can.
Yep. Okay. So intraday this week, right? This chart was the intraday of the C fund that we showed last week. So if you recall, I said that depending on how Monday morning went, subscribers to the site shouldn't be surprised to get an email and a text. So that is what happened. And why did I say that? Conan was like, this is a foot stomp. And here's why. We've been talking about impulse moves and corrective moves. So if we start down here, we had a move, right? And we had a correction from that. And then we have an ABC, right? It's a three leg. A 3 is corrective, a 5 is impulse. So this is corrective. So as soon as we saw this gap down, we should expect the market to go lower, which it did on an intraday basis, right? It came down an ABC again to this double bottom, which made a bigger ABC. That was the correction to this longer move here. After that, we get a 1, 2, 3, 4, 5. That's an impulse move. That's awesome. It means the market's going up. It doesn't go up in a straight line. It does an impulse move, does a correction, does an impulse move, does a correction, and that's what we saw here. We got this impulse move here. I'll say it's impulse. I don't have 5 legs to show you, but we had an ABC correction. We got a 1, 2, 3, 4, 5 impulse move. We got an ABC correction. And then, like I said, this is 1 month where each tick is 30 minutes. So we then had a 1, 2, 3, and closed on Friday right there. So we were hitting resistance at, this says it's the 117 30-minute where moving average. That it roughly correlates to the 10-day moving average. So we had this ABC correction, retraced to the 61.8 retracement level on what could have been an ABC, but it looked pretty powerful. So depending on if it hit resistance here and rolled over, fine. But I was really watching because on Monday, so here's where we were last Friday, and this is what happened on Monday morning, right? So I was anticipating, I didn't know that was going to happen, but obviously I was anticipating it because if we gapped up, which we did, then clearly this is a 1, 2, 3, 4, 5, right? So it continues the impulse move. So we had the impulse move, 1, 2, 3 correction, impulse move, 1, 2, 3 correction, impulse move. You know, it can keep going. That's how it goes when the overall market's going up. So that's pretty much why the alert came out on Monday, and that's kind of how I use the intraday charts to make these decisions.
And the idea too was it was a very tactical decision versus because we knew we had the moves left,
right?
And we weren't willing to risk that it didn't follow that pattern, right?
Right. So for me,
that's the big takeaway is that we didn't know, so we weren't going to risk where it could have gone,
right?
So and we had the moves, so we pulled out.
Right. Two weeks ago we got out. Right. This Monday we got back in.
That's what I mean. We found a safe spot, right? And we were like, all right, well let's let it play out.
Yep.
Let's see if the trend continues forward. Then we'll jump back in.
Which is exactly what we
did. Did we potentially lose a % here or there? Maybe.
We actually did not.
Exactly. Well, I know we didn't, but I'm just saying, like,
sometimes
in general, as this rolls through, it could happen.
Yeah.
But we're not willing to lose the big drop. Right. So we're going to get out, take a look at the market.
Exactly.
Let it play out and then get back in.
Yeah. This last 2 alerts. So if I'm sure we've talked about Sharpe ratio a little bit on the show, and Sharpe ratio is basically a way that you can compare investment advisors or portfolios in terms of risk and rate of return that you get, right? So
the idea is that if you can have a huge rate of return, but if your risk was so high that you can't sleep at night,
right,
that's not a good thing. If your return was reasonable and your risk was very low, well, that's a nice place to be.
Right. That's what. If you have a lot of money invested in not just TSP but anywhere, that's what you want. You want the highest return you can get for the least amount of risk.
That's it.
Yeah. So in this case, over the last 2 weeks, we did a really good job. When we were out of the market was going down, and we made money in the F fund because the F fund was going up. Then we went back into the stock funds. Did we hit the exact bottom? Absolutely not. But we got out actually a little bit below, more or less right at. The I fund was quite a bit down. We definitely made money on the I fund this week. The CNS were about flat, but our risk was 0. So in terms of a Sharpe ratio, we did really, really well.
Very high.
Yeah. Okay. So this multi-cycle chart. All right. Ned Davis research. Everybody's been quoting this chart over the last few days. It's pretty interesting. So I'm not going to get into these individual things. The 1-year seasonality chart, the 4-year presidential cycle, and the 10-year decennial cycle. You can Google them and take a look at them individually if you want. But the chart that Ned Davis Research put up incorporates all 3 of these cycles, right? And that's what you get, the blue line. So they're calling it the S&P 500 cycle composite for 2021. It takes, let me zoom in on this. So it puts equal weight on each of those 3 seasonal cycles, right? The 1-year seasonal, the 4-year presidential, and the 10-year decennial. And the data goes all the way back to 1928. Okay, it goes from 28 to end of the year 2020, so that we can get a full year going forward on the chart that we're looking at. Okay. So if you combine all those things, we've talked about how seasonality. We're at the end of August, so August, September, October are the 3 most volatile months of the year, and you see that start to take place up there. That's why since 1928, when you combine all these things, you get this decline, which reflects that kind of seasonal kind of crashing. And so one other thing that's kind of important to look at here, the trend is more important than the level. Okay, so don't look at this like, holy crap, we're getting ready to crash and come back to some level over here. It's trying to represent. The trend is more important than the way it looks. It looks much worse than it potentially is. Let's put it that way. So, but there's a couple things to take a look at. Right now, there's a divergence because the S&P 500, the C fund, is this yellow dotted line. Okay, and that's where we are basically. I think it goes to. It was sometime this week they put this out, and you can see here's August. So it's a timely chart. It's not old. According to the historical data, which is all this is, we should have already started coming down.
So we look at the yellow line as kind of like what's happening right now.
Yes.
And the blue line is all of that history jumbled up and condensed into one thing.
Right.
Trying to give some context perspective to anybody trying to figure out that chart. That chart is taking a lot of years, a lot of cycles, a lot of market, and kind of cramming it into one line.
Yes.
And so what it tells us is, historically speaking, let's go back to the chart, that it doesn't matter like how far that line drops. What matters is the line is dropping.
Yes.
Right. Not how far. We're not saying, oh my gosh, there's going to be a 70% drop in the market. No, it doesn't mean that. It means historically, high probability.
Right.
We're looking at a downturn.
Yes, definitely.
That's what it means.
That's all it means.
All right.
Yeah. There's no Elliott wave here. There's
trying to translate that for us.
Yeah. No, that's good because the 3 cycles are actually pretty interesting. If you geek out on it, then Google them. The seasonal cycle you can find really easy. We did that a few weeks ago on stockcharts.com. You can find the seasonal cycles. The 4-year presidential cycle, in this case, it's the first year of a new president's cycle. That's what that is. And the 10-year decennial cycle, it's complicated. So if you're interested, check it out. But every 10 years, if you stack 10-year sections on top of each other, the 1 year, the 2 year, the 3 year, each one individually, and you compile all them, it can show you that like in the 1 year, the market usually goes down. In the 7 and 8 year, the market almost always goes up. It's like that. Mm-hmm. So that's the one that's what the.
So what's our takeaway from this chart?
So here's what I'm thinking. We have a divergence right now. The C fund is still going up, and history tells us that by now we should have started coming down. There are plenty of divergences that happened over the course of this year, right? The seasonal said we went up here and we came down. Now it eventually resolved. We turned back around and went up, and and it came down and the market came down. I mean, it more or less, follows together. That's not exact, but more or less. It has not followed in the past couple of months. Historically, we've gone down, but in reality, this year we've continued up. What are the odds?
What's that one dip there? Is that COVID or there with the?
No. This is just 2021.
Oh.
Yeah. No, this is which dip, you mean on one of these, on one of the yellow lines?
Yeah, it's hard for me because I'm not on there.
Yeah.
The farthest one up there, that where you were just kind of drawing that box around. There's that one right there.
Yeah, I'm not sure. I mean, basically that's the last time that it hit the 50-day moving average, because if you remember, basically the 50-day goes like that, and we've never, other than back here, we've never hit it. So it's more or less along the 50-day moving average line.
And that's one of the hard things about these kind of charts, which is why we need guys like you, right? Is because you're used to looking at so many different time frames and so many different things. So when you look at that, you automatically know kind of like the context and where it's at. Like, okay, this looks crazy, but this isn't so much that crazy. Because then if you look at that, it's like, oh, what's that big dip down there? Yeah. And it's really not. It's more of like, you're putting a lot of data into two lines. But again, back to what's the takeaway from this?
Yeah, actually, that's a really good point I did not point it out really well enough. This is the composite for 2021. The chart started in January 2021. So what this is calling for is not like maybe sometime in the future we might get a dip. It's really calling for like we're overdue for the dip, and okay, we've avoided this piece right here.
But historically speaking, there's a high probability. Yeah. Right. Not maybe, but there's a high probability based on historical charts that we're just kind of marking time.
Yeah, we're due.
We're due. Yeah.
And that's not counting the Elliott wave counts and the Fibonacci retracements and the technical analysis.
Which we covered in the last couple of episodes pretty well. If you guys didn't watch those, go back and look at that. Right. If you go back and look at how Jerry kind of drew the kind of two,
long-term
possibilities that are out there, and the one that he believes we're on, and the one that other people think we're on. There's kind of two takes on it. Go back and look at that, and then compare it to what we're talking about now, and you're kind of getting the same answer, right? You're kind of getting the same thing, which is we're due for a downturn.
Yes, it doesn't mean it's the top of the market. The market's going to crash for the next 5 years. That's not what we're saying. But if there's going to be a downturn this year, because there hasn't been yet, if there is going to be, historically speaking, it's like yesterday.
Yeah. And and here's I think the takeaway is we're watching for it, right?
Yes.
It's like anything else where it's way better to be prepared.
That's all this is.
We're being prepared. Yeah. If it doesn't happen, that's fine. We're prepared for the other option.
We're 100% invested in the stock funds right now.
It's way better. And so the choices you have here, if you guys haven't figured out, and those of you that watch the show every week, you probably get tired of hearing this, but it is what it is. Sometimes we have a lot of new people, but what we advocate is actively managing your TSP. Right. If you're passively managing it, and you're true buy and hold, I'm putting my money in C or CNS or CS and letting it ride for 30 years. Yep. Don't listen to this, because you're a passive investor. If you're going to put it in 2065 and just let it go for the next 30 years, you're a passive investor. Right. That's not what we're talking about. If you think that actively managing it, you can, generally speaking, be in on the uptrends and out on the downtrends, then that's what we're talking about. And so you have to be prepared. So if you're doing that, what you're doing is like, okay, historically speaking, this may be coming up. So I got my plan A. Right. My plan B is if that doesn't happen.
Right. That's all it is. Yeah. I mean, that's all it is. It's preparation is a great way to say it. Okay. So again, no guarantees. This is a whole bunch of overlapping data, but it's timely, right? It's not theoretical that might happen next month or next year. It's pretty much, we're looking at what history expects us to happen over the next couple of months. Okay, Spotify. There's quite a few things going on here in Spotify, which is why I wanted to use it as the bonus chart of the week. So gaps are pretty interesting things. We had a double bottom here in Spotify. Had a pretty good run. 1, 2, 3, 4, and on that gap, it was a great time to buy it. We had that 5. Then we had a 1, 2, 3. Surprise, surprise. And at some point, we had a 1, 2, 3, 4, 5, but then we couldn't get above it. And once we got down here, that was a great time to sell it. The gap is important. And now we have this head and shoulders pattern that is pretty frightening looking, right? This would be the neckline for the head and shoulders. It's roughly at 225, I think, is a neckline, and we broke it down here. We broke it. Came back up, couldn't put in a higher high, right? So we got a lower high, came back down, and now we get a lower low. And then this week, we actually came back and we're retesting that neckline. If I was interested in trading Spotify, I would be much more looking to sell it than buy it at this point, because you got a lower low and you got lower highs. So we're definitely in a downtrend. That's the sort of bearish way of looking at it. From the bullish perspective, we just about hit that 200 line, and that's right at where that gap was. So we did we filled the gap. There's a theory that most gaps get filled. And so it took a year and change, right? This was last June, and it's August. So it took a year and change for the market to do its thing and eventually come back and fill that gap. And a lot of times it goes higher from there once it fills the gap. So just some things to think about. It was just a chart that I saw that looked pretty interesting because of both the gap and the head and shoulders pattern, and where it's kind of playing right now. It hasn't ordinarily on head and shoulders, when it breaks that neckline, it just plummets, and it didn't. So this is either a retest of the neckline right here, and it rolls over, or it's filled the gap and it's going to move higher. So if you want to follow Spotify, have at it. Okay. The TSP 18-month weekly charts. We actually had to move out to 19 months so that we can still keep the perspective of the COVID top and bottom in there. Like we've been talking about here for weeks, as long as the C fund 19-month weekly. So each tick is a week. The blue line is the 10-week moving average line, which roughly corresponds to the 50-day moving average line. And as long as on a weekly basis we stay above the 50-day moving average line, the market's going up. So if you're only thinking about trading your TSP based on the weekly charts, there's no reason to be out of the C fund right now. The RSI has been flat, above 80 for quite a while. MACD, totally flat, all is slow stochastic. They're overbought, but the term overbought doesn't mean that price can't go higher, because obviously back here, everything got overbought and the price has continued to go higher. So price is always the most important indicator, and as long as price stays above the 50-day moving average, 50-day or 10-week moving average line, no reason not to be in the C fund on a weekly basis. But then again, I make decisions on a daily basis, not on a weekly basis. So if you're only looking at it once a week, that's what you look at. All right. S fund. S fund has been in this horizontal channel for almost all of 2021. This was a huge week for the S fund. It was up almost 4.5%, and it closed above all the prior highs. So it could be the beginning of a breakout for the S fund. What I would really like to see is if this is 1, 2, 3, 4, 5, or maybe this is 5 and ABC is 2. Either way, this is going to be some kind of 1, 2, 3, 4, 5. That would be my expectation in terms of Elliott wave for the S fund. you got the indicators. What's basically, a lot of times what happens is when the indicators go from overbought, where it's in the green shaded, it's when it breaks down, price tends to break down. In this case, instead of correcting down, it corrected sideways. So the momentum continues lower, right? Everything's continuing lower in terms of the indicators, but the price is sort of staying where it's at. It's consolidating, it's not correcting, and that's fine. If MACD turns back up, price will continue higher, and then we'll have plenty of room for MACD to go higher. Slow stochastic will just bumble around up there above 80, and price will go higher. I mean, it's consistent with a Elliott wave pattern. So we'll have to see what happens in the S fund. I've been pretty bullish the S fund because I've been waiting for it to break out of this pattern. And the basic idea is that the market breaks out of a horizontal pattern in the direction of the prior trend, which the prior trend was up. So basic theory, technical analysis theory should be like that. Okay. iFund is in a similar kind of boat. It's basically 1, 2, 3, 4, and I think we're in a 5 on the iFund also. It's a pretty similar chart to the S fund, and we'll have to see what happens. F fund, as long as it stays above the 10-week moving average line, if you're in the F fund, you know, you're in pretty good shape. It's just that, like we said last week, you don't get the bang for the buck in the F fund that you do in the stock fund. So if you're trying to maximize, if your goal is to maximize your TSP, you want to be in the stock funds when the market's moving up. If the F fund is moving up, that's great, but on a percentage basis, it's not moving up anywhere near as much.
Yeah, it's not a huge bang for your buck, but it's better than zero.
It's way better than zero. If the stock funds are going down, a lot of people think that the bond funds work inversely to the stock funds, and that's not true. So if the stock funds are going down 8 times out of 10, I'm going to the G fund, not the F. But if the F chart looks really good, I'll go to the F instead of the G, but only if the F fund chart looks really, really good.
Right. We're looking at all of them.
Yeah.
Questions?
That
was quick, man.
It was pretty quick.
Yeah.
Half an hour or so.
Like half an hour. If you have any questions, you can put them in the comments section, wherever you find this video, whether it's YouTube, Facebook, Vimeo, all the places that we put it. We actually have had a few people kind of comment, hey, where can I find everything? Yeah. And right this minute, just to be completely transparent, nowhere. Generally speaking, you can find all of the shows, all of the previous shows that we've done for the last year that we've been doing this on YouTube.
Yep.
And YouTube is what you are looking at when you're looking at our website. What we do is we also publish it on Facebook to kind of, make Facebook happy.
Yep.
Right. So we actually put it on Facebook on our page, and that's what a lot of people might see it there. And then what we started kind of doing is tinkering around with a thing called Vimeo, which allows us to kind of do a bunch of different things. So until we kind of get the platform figured out, we don't know exactly where we're going to. You'll always find all of the shows on YouTube. We're never going to change that, right? Because that's where a lot of people kind of, they feel comfortable, right? But a lot of the other things we put out, like live streams and all that, everything can always be found on our website.
In Facebook too. I mean, it'll be in the videos on Facebook.
Yeah, if you're in our Facebook public group, right? If you're in that group, everything's there. Yeah. I don't know how easy it is to find. It's probably not, because Facebook doesn't really do that. But at the end of the day, you can find everything on YouTube and on our website. We post all of the live stream things under growmytsp.com/live, and then all of the shows are on YouTube. So anyway, we had a few comments about that. I thought I'd kind of address it. Yeah. We really appreciate the fact that so many people you watch the show. If you have any, ideas about what you'd rather us talk about or see, give us some comments. And at the end of the day, please share it with your friends if you like it. All right. Yeah. We are going to get on with our weekend, and we hope you have had a great weekend, and we will see you next week.
Later.